Welcome all to FSA Learning Module 5, some EOC cues on the module covering analysis of cash flows, part 2, the sequel. One appropriate method of preparing a common-size cash flow statement is to show each line item. So what do? We take a line item, and you have a choice, two ways of doing it in the cash flow statement. You could show it as a percentage of net revenue, or you could take it as a percentage of total cash inflows if it's an inflow, and as a percentage of total cash outflows if it's an outflow. What choices do we have? A, show each line item of revenue and expense as a percentage of net revenue. Well, no, because revenue and expenses are in the income statement, not the cash flow statement, so that's just all sorts of wrong. B, on the cash flow statement, show each line item on that. Well, yeah, we're talking about the cash flow, so, geez, how bad was A? On the cash flow statement as a percentage of net revenue, that's this one, that's that, yep. On the cash flow statement as a percentage of total cash outflows. Now, you can't say that because you don't show the inflows as a percentage of cash outflows, so it's not C, is B. Which of the following is an appropriate method of computing free cash flow to the firm? FC, FF. Okay, what do I know about FCFF? I start with my net income, but that's not cash. So I need to add back my non-cash charges and deduct working capital investment. That's the movement in accounts payable, receivable, inventory. That will get me to a cash flow. It is not yet free to spend because I need to spend money to keep my business going. So I'll need to knock out what I spend on fixed capital investment to maintain and grow the business. Now I have a free cash flow, but it's got to be to the firm. To the firm means available to everybody, available to all. So it's my big bag of cash, my big sack of cash, before I've paid out anybody, which means it has to be pre-interest. So I need to add back my interest after tax. That's FCFF. Now we know from our cash flow analysis part 1 that if you take net income, adjust for your non-cash charges and your working capital movements, you get CFO. So those three together give you CFO. You would then simply knock off your fixed capital investment and add back interest. Let's see what we've got. Add operating cash flows to capital expenditures. No, that doesn't work. You have to deduct from CFO. B, add operating cash flows to after-tax interest payments. CFO added to interest. Deduct capital expenditures. B looks like a winner. Deduct both after-tax interest payments and CapEx from... No, you add it back. You don't deduct. C is out. Answer is B. The first step in cash flow statement analysis should be to evaluate the consistency of cash flows. I'd like to know what the cash flows were first before I start to evaluate them. Determine operating cash flow drivers. I will give the same answer. Before I do either of these, I want to know what are they? What cash flows should I be studying? C, identify the major sources and uses of cash. Yep. Once I know the major sources and uses, absolutely, I will then want to start studying them. But C has to be my first step. An analyst has calculated a ratio using as the numerator the sum of operating cash flow, interest, and taxes. So we've taken operating cash flow, added back interest and taxes, and as the denominator, there you go, the amount of interest. What is this ratio? It's how much we've got available to meet our interest payments. It is interest coverage. What does it measure? Well, it's our ability to pay our interest. Why are we interested, no pun intended, in our ability to pay interest? Solvency. What does it indicate? Well, how solvent we are. If it's higher, then we have a lower risk of not meeting our payments, a lower financial, terrible writing, a lower financial risk. And a mix of upper and lower case, that's unacceptable. Lower financial risk. So, what are the answers? This ratio is an interest coverage ratio. It is. Measuring a company's ability to meet its obligations. It is. And indicating its solvency. Yep, I can't fault A in any way. B, it's not a terrible answer. It's not effective tax at all. Operating profitability, no. So basically, we just needed to spot it. That would have been enough to get to A.